Hey, I'm Jaken. Welcome back to another video. Today, we're going to talk about a problem I'm seeing with deals coming in. This is January 18th right now. We've seen about 100 deals come in for the month, and about 30% of these deals that are coming in are people coming to maturity on a hard money loan. Kind of makes sense, the boom at the beginning of last year, everyone was getting into deals. They're maturing on hard money loans, and the value added doesn't quite allow someone to pay off the first and come in with the second. I also saw a video the other day where someone who works for a direct lender that I'm not going to name on here, but the direct lender was requiring them to buy down the equity position, or basically add equity to the deal by buying it down because the leverage was too high. I'm seeing that too. To get out of this, there's a couple different things. One, you have to, you could either extend and pay exorbitant fees, or you set yourself up so that your cost basis can justify a value that would allow a payoff of the first position or your current hard money lender. A way to do that, for us, we can probably go up to 80% of the as is value and give you money for rehab, but you need to substantiate that, right? A deal submitted to me today, for example, was they were all in at 170 that was their debt, and they thought it was worth 200. If you do the simple math on that, I can't be, they're over leveraged on that. If they go to extend, their lender's either going to say no thanks, or they're going to say you need to buy us down $20,000-$30,000 to reposition the debt so that it's not over leveraged. So, and on top of that, the loans 12 months ago were, LTVs were open wide up, whereas now a lot of the LTVs are shrinking in terms of those kinds of projects. So first of all, you don't want to ever be in that position. And your lender should really be kind of checking in with you on progress so you don't end up in that position. Because, if I'm seeing it, and again, I'm not super high volume. We do plenty of deals. But if I'm seeing 30% of my deals come in be these over leveraged, we call them mid swings, well, there's a problem there, I think. So, there's a way out, and the way out is really because we're still gonna have to send an appraiser out and do it again. So the real way to get around this is to do your best to substantiate the value that you have done to get the most out of the value for today. On that deal that I just told you about, I said, is there any way you can sell a 230 to an appraiser? Meaning your cost basis is this. What are other properties going for? Can you create a narrative such that an appraiser will accept that you've done this much work, they'll value it at 230, and then I can pay off the first, put you in a new loan, and be ready to go. So you need to be thinking about this as an investor. The 12 months is a long time, but it's not really a long time, right? So you need to be on top of where you're at in the progress. Some lenders have these things called progress defaults, which is like, if you haven't made so much progress by X amount of months, you're in default. There's a reason for that, and it's that reason. So if you need help getting out of a scenario where you're about to mature on a hard money loan and you don't want to pay default interest, excessive default fees, buy down your current loan, or even get foreclosed on, my number's in the comments below or in this whatever description. Give me a call. It's not a great position to be in, and I'm not guaranteeing I can help everybody, but at the very minimum, I can get you a creative strategy to get out of it without incurring all those problems. So if you have any other questions, go ahead and leave a comment, shoot me a text, whatever. My number's there.